who would buy a deep in the money call option from me and why. If somebody wants the stock, they could outright buy it rather than going via an in-the-money option. If they expect further upside on the option's profit calculator is showing me the percentage profit will be the same for an option that's just in the money. And an option that's deep in the money just goes up with the stock. I'm wondering about liquidity if I hold a leap until it's too deep in the money. Well, you're looking at somebody who's been holding leaps his entire life, especially on disruptive stocks. And when they do things like stock splits, etc., they're always liquid. As long as you have a name. The only time I've ever had a challenge selling large blocks of like 3-digit plus contracts was CleanSpark. It took me weeks to get fills on those, but eventually I did. So it can happen. But liquidity for assets like this, not a problem. Let me explain who would buy a deep in the money call option and why. First of all, every asset has a price, as I started the show with. And the speculators, for example, buy deep in the money calls to profit from anticipated price increases in the underlying asset. And they can also participate in the potential upside with a limited upfront investment. But depends, that you're dead right. If something is, say, more than 50% in the money, it can get a little bit crazy. But sometimes some people don't have access to margin to buy stock straight. So they have to buy options. Also, investors seeking leverage can use deep in the money options to control a larger position. For example, if they're afraid of a 50% downturn, they can sell an in the money position against their long position. And this leverage allows them to amplify potential returns. And we love to amplify returns here. Also, hedgers use deep in the money call options to mitigate the risks associated with their existing positions in the market. And these options can act as an insurance policy. And finally, arbitrageurs exploit price inefficiencies. It's a big part of my game too, between different markets and related assets. They can, for example, what I like to do a lot is scan for mispriced deep in the money call options, take advantage of price discrepancies and attempt to profit by simultaneously selling the underlying asset or similar options to capture the price differential. So there's lots of fun you can have, and hope that answers your question. But let's look at one real one, for example, which I actually have some of. This is a deep in the money call option on Tesla. Strike is $100, goes out to January 2025. And even though the stock price, like if you look at the pure intrinsic value of this option, it's about 156, it's selling for 168. So you got that extra $13 worth of time value that's embedded in this option. Obviously, the less intrinsic value you have, the more time value you have, the more volatility, etc. But again, this can be sold tomorrow, and you can watch these yourself. You can look at the daily trading volume of these and how close they are, and you can calculate your IV versus time value all the time too. So